All right, welcome back to the deep dive. Today, we're going to be tackling a legend.
We are. We're diving into the world of Warren Buffett.
Yeah, and using a book that I think a lot of people consider like the
Buffett.
kind of of Warren Buffett's Way.
Yeah, Robert Hagstrom's the Warren Buffett way. Yeah.
The Warren Buffett Way by Robert Hagstrom. And one of the things that makes this deep dive really interesting is we're not just relying on Robert Hagstrom's take.
Right.
We have excerpts from the book, including the author's background and things like that. But, we also have like forewords and prefaces and introductions by all these other incredible investors.
It's amazing. Yeah. We've got Jay Chow, Ray Housey.
Yeah, Chen Chongsheng,
Bill Miller,
Peter Lynch,
Kenneth Fisher, the translator. So it's just this really interesting kind of multifaceted view of Warren Buffett and his approach, which I think will be really interesting to unpack.
Yeah. And, the goal of this deep dive is to really understand what's made Warren Buffett so successful. And, we're not just going to focus on what he did, but really the thinking behind it. And the cool thing is that this book, this deep dive, what we're talking about, this isn't just for people that want to be stock pickers. This is fundamental wisdom about what makes a good business and how to create value.
Exactly. It's enduring principles they apply over and over again.
Exactly. So, okay, the Warren Buffett Way. Let's start with the book itself. What made Hagstrom write this book? What was the genesis of this?
Hagstrom, it's interesting. He's not just an academic.
Right.
He's actually a senior vice president and portfolio manager at Legg Mason Capital Management.
Right.
So he was deeply entrenched in the world of investing and finance.
Oh, wow.
But he was really curious. He was really trying to figure out, how did Buffett achieve these extraordinary results with what seemed like a very simple, almost non-extraordinary approach? So he saw this really effective method that maybe wasn't flashy, but was incredibly consistent. And his thinking was if we can understand it, maybe we can replicate it.
Yeah, and I think what's interesting too is that, as Jay Chow points out in the book, it became an instant success when it came out, and it really has become kind of a cornerstone of investment literature. It's one of those books that's almost if you're interested in investing, you have to read this book. And I think it tapped into this idea, maybe you don't need a super complicated algorithm or some kind of insider information to succeed. Maybe it's just about being more thoughtful and more kind of grounded.
Yeah. I think you're right. And what I really appreciate about Hagstrom's work is that he doesn't just celebrate the wins, right? He actually dissects the reasoning behind the investment decisions. So for our listener, this is so important because it allows you to understand the why behind Buffett's choices, which is much more valuable than just knowing what he did.
Absolutely.
And it gives you a framework for your own thinking.
So how did Hagstrom organize all this?
Well, yeah. He basically distilled Buffett's approach into 12 key principles.
12 core principles. Okay.
12 core principles. And he groups them into 4 categories, which, this is helpful. Business tenets. And these focus on, the characteristics of the companies that Buffett invests in.
Okay.
Management tenets, which look at the people running those companies.
Right.
Financial tenets, which focus on, the numbers, the balance sheet, the income statement, all of that. And then finally, value tenets. And these are the things that really guide his buying decisions.
Yeah.
So this framework helps us understand all the different facets of Buffett's approach, how it all comes together.
Yeah. And it's interesting because, Jay Chow and Ray Housey, they both emphasize in their sections the importance of not just reading these 12 principles, but really trying to internalize them. Housey even goes as far as to say, try to explain them to other people. Because, it's that old thing, right? You don't really learn something until you have to teach it.
Yeah. If you can explain it, you probably understand it.
Right.
If you can't explain it to someone in a way that they can understand it,
right,
you probably haven't internalized it yourself.
Right.
So that's a really great point.
Now, Buffett's investment philosophy didn't just appear out of nowhere, right? He had some significant influences. And one of the, I think, most prominent names is Benjamin Graham.
Oh, absolutely.
The father of value investing.
Yeah. So his influence on Buffett is foundational, right? If you were to draw a tree of, the people who inspired Warren Buffett's investing, Benjamin Graham would be at the root of that tree.
For sure.
And from his books like The Intelligent Investor and Security Analysis, Graham really taught Buffett a lot of things. But the most critical thing was the concept of margin of safety.
Yeah.
It was essentially buying a business for much less than it's worth.
Right.
So there's this idea that you have this cushion to protect yourself from errors in judgment or even like unexpected events.
Right.
And he really was adamant about this difference between investing and speculating. Like, investing was about rigorous analysis, safety of principle, and then a satisfactory return.
Right.
Whereas speculation, in his view, lacked that analytical rigor.
Yeah.
So it was much more like gambling.
Well, and Graham, I mean, he really had some pretty specific ways to identify undervalued stocks. Like what were some of those ways that he was thinking about?
So Hagstrom highlights two primary methods that Graham favored. One was buying stocks that were trading at less than 2/3 of their net current asset value.
Okay.
So essentially, you were valuing the company solely based on its most liquid assets. You're just saying, okay, if we were to liquidate this company today, how much cash would we get?
Right.
And is it trading for less than that?
Yeah.
And then he was providing a substantial margin of safety there. The other approach was just looking for companies with a very low price to earnings ratio.
Okay.
So it suggested that they were very undervalued relative to their current earning power. And Buffett famously called these cigar butt investments.
Cigar butt.
Yeah.
Okay.
So it's like the businesses aren't great, but they're so cheap, like you could just get a few last puffs of value out of them
Got it.
before you discard them.
Right. So then along came Philip Fisher, and it seems like he kind of opened up Buffett's thinking beyond just these like really deep bargain type investments.
Yeah, I think that's right.
Yeah.
So, Fisher really emphasized investing in companies that had strong growth potential.
Yeah.
And this is key, like exceptional management teams.
Okay.
He really put a lot of emphasis on the quality of the people running the business.
Okay.
And his approach was all about deep, ongoing research. And he called this scuttlebutt. So this involved, talking to like customers, competitors, suppliers,
Interesting.
even former employees,
Yeah.
to get a very holistic understanding of the business.
Right.
And he also advocated for concentrated portfolios. So he believed that investors should really do their homework and then focus their capital on their very best ideas,
Okay.
not just spread it around thinly.
And it's interesting. Kenneth Fisher, his son, he highlights that Buffett's later emphasis on this concentrated investing idea and like really paying attention to like market news and company news abnormalities had roots in Fisher's thinking. So it wasn't just about like find the cheapest stock. It was about like find a really great business even if it wasn't trading at a huge discount.
Yeah, I think you're right. And, Fisher really pushed the focus beyond just like the quantitative metrics to the qualitative aspects of a business. Like how good is the management team? What are the long-term prospects of this business?
Right. So next we have John Burr Williams,
Okay.
who gave us the dividend discount model,
Yes.
which, I mean, that sounds super complicated.
It sounds complicated, but it's actually pretty straightforward.
Right.
So he basically proposed in his book, The Theory of Investment Value, that the intrinsic value of a stock is the present value of all of its future cash flows.
Okay.
Or, in his initial model, he used dividends.
Okay.
So like how much in dividends is this company going to pay out over its lifetime?
Right.
And then you would discount those back to the present value. Because a dollar you receive in the future is not worth as much as a dollar you have today.
Right.
Because of inflation and because you could earn interest on that dollar today.
Okay.
So this model was a way to account for that.
So you're basically trying to figure out like how much cash this company is going to make for the owners in the future, and then like adjusting for the time value of money to see what it's actually worth today.
That's it. That's a great explanation. And, Buffett has actually adapted this to focus on the present value of net cash flows.
Yeah.
And he discounts that at an appropriate interest rate. So it's about looking beyond just like what the stock is doing on a day-to-day basis to really understand how much cash this business is going to generate over the long term.
Right. And finally, we have Charlie Munger,
Yes.
the other half of the dynamic duo.
The other half. And I think Munger's impact on Buffett's investing was really profound.
Yeah.
So Jay Chow says that Munger really pushed Buffett to move beyond those cigar butt investments.
Right.
The really cheap, maybe mediocre businesses.
Yeah.
Towards buying really wonderful companies at a fair price.
Yeah.
And this was a crucial shift because it recognized that, an exceptional business, even if it's not trading at like a super bargain basement price, it's going to produce much better returns over the long run.
Right.
So Munger brought this like broader intellectual framework to Buffett's decision making. He really emphasized the importance of understanding like business models, and competitive advantages.
Okay. So building on these ideas, Hagstrom outlines Buffett's core tenets.
Yes.
Let's dive into some of those.
Okay.
And I think, like, as we go through these, it's interesting for you, the listener, to think about, like, how can I apply these principles to my own financial decisions?
Sure.
And even, like, just understanding how businesses work in general. So the first one is understandable businesses,
Right.
often referred to as, like, his circle of competence.
Yeah. This is absolutely fundamental to Buffett's approach. Like, he constantly stresses that.
Yeah.
Right. He says, only invest in businesses that you truly understand. And Ray Halsey makes a great point here. He says, it's not just about whether the company is in an industry that you understand, but also whether the company understands its own strengths. So it's like, can they clearly articulate what they're good at? And do they avoid what Buffett calls diversification? Diversification. So it's like, the opposite of diversification.
Oh, okay.
Where they're just spreading themselves too thin into too many different things.
Got it.
And they don't have a real competence there.
So basically, don't be a jack of all trades in the investment world. Like, stick to what you know. If you can't explain how a business makes money, you probably shouldn't be putting your money into it.
Yeah.
Right?
And it's about focusing your research and your analysis on areas where you have an advantage.
Right.
Where you can really understand the dynamics of the business and the potential risks.
Okay. So the next tenet is consistent operating history. So this seems to suggest, like, a preference for companies that, like, have a proven track record, right?
That's it. He's not looking for those speculative turnaround stories.
Right.
He's looking for companies that have a long and stable history of profitability. And this is a key difference from, like, the cigar butt approach,
Right.
which is often companies that have a really bad past.
Right.
He wants to see companies that have weathered different economic conditions.
Right.
And can consistently deliver results.
So it's about finding those businesses that have shown they can handle things when the economy is bad and still, make a profit.
Right. And, it's like past performance isn't a guarantee of future results, of course.
Right.
But, if you see a long track record of success, that definitely gives you a certain level of confidence.
Yeah, for sure. And closely linked to that is the idea of favorable long-term prospects, or what Buffett famously calls an economic moat.
Yes, the moat.
This is about, like, a competitive advantage, like something that prevents competitors from coming in and taking all the profits.
That's it. It's like a sustainable competitive advantage.
Yeah.
That allows a company to defend its market share, its profitability. Ray Halsey describes it as like a durable competitive advantage that reduces a company's dependence on any single individual. So it's not just about one brilliant CEO.
Right.
It's about something that's built into the structure of the business.
Got it.
And this could be like a strong brand, like Coca-Cola.
Right.
Or a patented technology. A network effect like we see with social media platforms, or like significant cost advantages.
So, like, Amazon with their distribution, like, that's a moat. That's really hard for another company to replicate.
Exactly.
And Apple with their customer loyalty.
It's hard to compete with that.
Right.
It's very hard.
Yeah.
So wide and deep economic moat, it's really the hallmark of a business that can create a lot of value over the long run.
So moving on, Buffett, he puts so much emphasis on management.
Oh, yeah.
And he really starts with this idea of rational management.
Yes. So rationality in management, it really boils down to smart capital allocation.
Okay.
So how does the management team decide to reinvest the earnings of the company? Do they make acquisitions? Do they pay down debt? Do they give dividends? Do they buy back stock? A rational management team is going to make these decisions in a way that's going to maximize value for the shareholders.
Okay. So it's not just about, like, making a profit. It's about how you use that profit. And, are you spending it wisely to grow the company, or are you just doing things because it makes you look good or because you want to buy a fancy jet or something like that?
Exactly. And tied to that is the idea of honest management.
Yeah.
This might seem obvious, but it's super important. When you're entrusting your money to someone to run a business, you want to know that they're honest.
Right.
Right.
You want to know that they're telling the truth, even when things aren't good.
Exactly.
Right. Like, they're lying to you when things are good. What are they going to do when things are bad?
And Ray Halsey emphasizes this. He says, management is acting as stewards of the capital that shareholders have entrusted to them. Honesty, transparency are paramount.
Right.
You want a management team that's forthright and direct with shareholders,
Hmm.
especially when things aren't going well.
Yeah.
If they're willing to be open about challenges,
Yeah.
that's usually a pretty good indicator of integrity.
Yeah. It builds trust.
Yeah.
It allows investors to make informed decisions.
Yeah,
So-
exactly.
And the final management tenet is independent management.
Yes.
So this refers to the ability of the management team to like make decisions that are in the best interests of the company, even
Yeah.
if they're unpopular, right?
Yeah.
Even if they go against what everybody else in the industry is doing.
Yeah, that's a great point.
Mm.
Ray Housey gives this example of, Berkshire's profitable insurance underwriting business. And he says, even when a lot of other insurance companies were sacrificing profitability to gain market share,
Oh, interesting.
Buffett's team, they refused to follow the herd
Interesting.
because they believed it was in the best interest of the business and the shareholders.
Yeah, they weren't just following the trend.
No.
Yeah.
And they actually had the conviction to stand alone, to stand against the crowd.
Right. Right.
Which, in Chinese you could say, got.
Too.
Right. Oh, that's
Which means to like stand alone against different opinions.
Got it. Got it. So moving on to the financial tenets now.
Okay.
We have high return on equity, ROE, and owner earnings. Yes. So these are two of the key metrics that Buffett uses to assess a company's financial health. So return on equity basically tells you how effectively the company is using the money invested by shareholders to generate profits. So a high ROE generally indicates that the company is very efficient in deploying capital. Now, owner earnings is a bit more nuanced. It's a term that Buffett actually coined himself, and it really represents the cash that a company generates that's truly available to its owners after accounting for all the necessary capital expenditures to maintain the business and to stay competitive.
Okay.
So he favors companies with high owner earnings because it gives them a lot of flexibility to reinvest, to make acquisitions, to return capital to shareholders through dividends or buybacks.
Okay. So RO is just like, how good are you at making money from the owner's investments? And then owner earnings is like, okay, but how much actual cash is flowing back to the owners, like free and clear?
That's it.
Okay. Okay.
And Ray Housey actually points out that, alongside high ROE, Buffett also looks for high profitability. And he gives the example of See's Candy. He said, this gave See's the power to price its products competitively and to be very resilient,
Yeah.
to be able to withstand competition.
Okay. So the next one is the $1 premise.
Yes.
I like the name of that. So what's that all about?
Yeah, the $1 premise. So this is basically the principle that for every dollar of earnings
Mm-hmm.
a company retains, and retains meaning, it doesn't pay it out as dividends.
Okay.
It keeps it to reinvest.
Yeah.
That retained dollar should translate into at least a dollar increase in the company's market value over time.
Okay.
So it's like, if they're going to keep that dollar and reinvest it,
Yeah.
they need to show that they can create value with it.
Okay. Got it. Got it. So then that brings us to the final category,
Yeah.
which is value tenets. And we start with kind of this critical idea of intrinsic value and margin of safety.
Yeah.
And we touched on the margin of safety a little bit before with Graham, but
Yeah.
like, how does Buffett actually go about determining the intrinsic value of a business?
So for Buffett, valuation, it doesn't come first.
Okay.
It comes last, after he's analyzed the business, the management, the financials, all of that. Then he comes to valuation. And intrinsic value, in his view, is really an estimate of what a company is truly worth based on its future free cash flow, discounted back to the present value.
Okay.
So, and Jay Chow mentioned this, he says it's about trying to project the company's future development
Okay.
from the perspective of an owner,
Okay.
a long-term owner.
Yeah.
And then the margin of safety is that difference between that estimated intrinsic value
Mhm.
and the price you pay for the stock.
Okay.
And you want that difference to be big.
So be conservative. Be
Mm.
conservative in your valuation and then only buy when there's a good discount.
Yeah, a big discount. And this is where Ray Housey really emphasizes the psychological aspect of investing.
Right.
He says the market often overreacts to news.
Mm.
And this creates these opportunities for people who can remain rational, who can think independently.
So this is where we really separate the men from the boys, as they say.
Yeah, this is where you see, who can really keep their head when everyone else is losing theirs.
Right. Right. So Buffett's investment style, it hasn't always been static. Like he's evolved and adapted over time, right?
Absolutely. He's a lifelong learner.
Yeah.
And Jay Chow and Kenneth Fisher both highlight this.
Yeah.
They say Buffett has constantly refined his approach.
Yeah.
And if we look at his early investments, they were very much influenced by Graham's focus on deep value.
Right.
But gradually, he started to integrate Fisher's emphasis on growth
Okay.
and management quality.
Okay.
And then, of course, Munger's influence on this idea of paying a fair price for a truly exceptional business.
Yeah. And like the investment in Apple is a good example of that, right? Like
Absolutely.
Buffett didn't he wasn't investing in tech companies, right? Like that was not his thing.
Yeah. He stayed away from tech for a long time because he felt it was outside of his circle of competence.
Right.
And Jay Chow mentions that this move really surprised a lot of people who'd been following Buffett for a long time.
Right.
And it really made people think like, okay, can this traditional value investing approach actually work in the fast-paced world of technology?
Right.
And Hagstrom argues that it can. He says, and Chow agrees with him, that just because something is unpredictable in the short term doesn't mean it's unanalyzable from a fundamental perspective. And you can look at Apple. It has this incredibly strong brand, a sticky ecosystem of products and services.
Yeah.
And it's consistently profitable.
Right. Right. And Kenneth Fisher adds that, like, Buffett's willingness to make these big bets, in areas that other people aren't expecting really shows that he's always learning and he's always adapting.
Yeah. And it's interesting because he sticks to this fundamental framework, but he's open to understanding new industries and how businesses evolve.
Right. So another theme that we see throughout all of this is this importance of having a long-term perspective. And I think maybe more importantly, like the right temperament.
Yeah.
Right.
Yeah. And Bill Miller really emphasizes this in his foreword.
Yeah.
He says, Buffett sees the stock market as a business, not a casino.
Right.
Right. And he stresses the need for patience,
Right.
a really long-term horizon.
Right. And it's interesting that, the translator, the Wai Liang, he talks about how, like, at the beginning, he was kind of stumbling into these investments, based on trends and that kind of thing. And then he realized that, like, there's much more value in actually, like, really understanding the business and doing your research.
All right. So it's not about, like, chasing the latest fad. It's about understanding the fundamentals.
Yeah. Exactly. And, Buffett himself has said that in investing, character traits like patience, discipline, these are more important than just raw intellect.
Right. You've got to be able to ride those waves,
Yeah.
when the market goes down. You have to be able to stay the course to not panic.
Right, right.
When everyone else is selling, he's often buying.
Right, right. And it's interesting to consider, how Buffett's principles might work in different markets, right?
Right.
Like different countries, different economies. And Chen-Chung Ching actually talks about like the challenges and the adaptations that you need to make when you're applying these principles in like the Taiwanese and mainland Chinese markets.
Yeah. He highlights that, even though like the companies are different, the markets are different,
Yeah.
the underlying principles like understanding the business, assessing management, analyzing financial health, and then, rigorously valuing it, these remain universally applicable,
Okay.
even in different markets like Taiwan and China.
Yeah.
And he points out that, Hagstrom later had success applying these same principles to technology stocks.
Right. Right.
So it really shows you that they're adaptable.
Yeah. Yeah. Peter Lynch and Kenneth Fisher both touch on Buffett's kind of well-known preference for concentrated investing.
Yeah.
Like really focusing on a small number of companies that he understands really well. What's the thinking behind that?
So concentrated investing really comes from Buffett's belief that you should only invest in businesses you truly understand.
Right.
So by focusing his capital on just a few high-conviction ideas, he can do much more thorough due diligence
Right.
and really have a greater impact.
Yeah. It's like put your eggs in a few baskets and watch those baskets.
That's it. And then, Chen-Chung Ching also talks about the importance of thinking like a business owner. He says, adopt this buy a business, not just a stock mentality.
Yeah. And I think that really gets at Buffett's like long-term approach, right? Like it's not just about buying a piece of paper that goes up and down in value. It's about buying a piece of a business, that's going to be around for hopefully decades to come.
Exactly. And whether or not he's involved in the day-to-day operations, he approaches stock ownership as if you were an owner.
Yeah.
He's focused on the long-term performance, the company's ability to generate cash,
Right.
and whether he can buy it at a discount to its intrinsic value.
Right.
So this mentality shifts the focus away from the short-term market fluctuations to the underlying strength and potential of that business.
So as we wrap up, like what are some of the like key takeaways that you would want the listener to kind of walk away with from this deep dive into the Warren Buffett way?
I think the biggest takeaway is that Buffett's 12 principles, the way that Hagstrom lays them out, they offer a really powerful and timeless framework for long-term wealth creation.
Mm,
And these principles emphasize the importance of, truly understanding the businesses you invest in, evaluating the management team, analyzing their financial health, and then focusing on intrinsic value and buying with a margin of safety. And I think it's really important to remember that Buffett's approach, it's not just about like following rules, right? It's about constantly learning, constantly adapting, and then applying these core principles to an ever-changing world.
yeah. And remember, like, the goal isn't to be Warren Buffett, right?
Right.
Like, there's only one Warren Buffett. The goal is to learn from his principles and develop your own investment approach. And I think Kenneth Fisher said it best. He said, learn from Buffett, but don't idolize him.
That's great advice.
Right. So as a final thought, I'd like you, the listener, to kind of consider which of those 12 principles resonates most with you. Like, what do you think you could apply to your own financial life?
Or even your professional life.
Or professional life, yeah. Like, how can you think about buying a business, even if you're not an investor, right? Like, what are those fundamental strengths and management qualities that you would look for in your own field if you were making, like, a long-term commitment?
That's a great question to think about.